Good morning, everyone, and welcome to the lecture on financial management. Today, we'll be conducting first unit of your syllabus. Now, in this particular video, we'll be learning about topics like introduction to business finance, meaning and definition of financial management, objectives of financial management like profit maximization and wealth maximization, then modern approaches to financial management like investment decisions, financing decisions, and dividend decisions, right? And of course, in the last, the functions of finance manager, right? Let's start the video. I'll be sharing my screen with you all, my presentation, and then I will start the lecture. Yes. So let's begin with this particular first unit, wherein we'll be understanding about the study slideshow. Okay. So, what is business finance? Let's understand it. Like we all know that money is required for carrying out any business activity, right? And that is called business finance. So, almost all business activities require some finance. Like finance is needed to establish a business, to run it, to modernize it, to expand or diversify it. So it is required for buying a variety of assets, which may be tangible like machinery, furniture, factories, buildings, offices, or it can be intangible like trademarks, patents, technical expertise, etc. So also finance is central, right, to run a day-to-day operations, we know, of business like buying raw materials, paying bills, paying salaries to the employees, collecting cash from the customers, the debtors, etc. So it is needed at every stage in the life of a business entity. So availability of adequate finance is therefore very crucial for survival and growth of a business. We all understand this. So a business is related to production, distribution of goods and services for the fulfillment and requirement of society. For effectively carrying out various activities, business requires finance, which is called business finance, right? So hence, business finance is also called as a lifeblood of any business. A business would get stranded unless there are sufficient funds available for utilization. So the capital invested by an entrepreneur to set up a business is not sufficient to meet the financial requirements of a business, right? So it's something we require regularly. Let's understand the definition of finance given by Khan and Jain. It says that finance is the art and science of managing money, how you manage money. And Gutman and Dougal, they said that business finance can broadly be defined as the activity concerned with planning, raising, controlling, administering of the funds used in the business, right? There are many more definitions given uh, about business finance, but you can write any one in your exam if it is asked, right? But it should be word to word. Now, let's understand what are the objectives of financial management. The very first objective of financial management is profit maximization. So, profits act as a measure of efficiency. Like if you have a more profit, you are running your business more efficiently. So, it's a measure of your efficiency, that how efficiently you run your business. And second is it serves as a protection against risk. So there are few arguments in favor of profit maximization as objective, wherein when profit earning is the main aim of business, the ultimate objective should be profit maximization. Future is uncertain, we all know. So a firm should earn more and more profit to meet the future contingencies. So profit maximization is justified on the grounds of rationality, as profits acts as a measure of efficiency of any business. Although there are few uh, arguments as well. So let's understand what is wealth maximization. Wealth maximization is considered as the appropriate objective of an enterprise when the firm maximizes the stakeholders' wealth. The individual stakeholder can use this wealth to maximize his individual equity utility. That means it is about, we're talking about equity shareholders, we're talking about people who invest in the business, right? So these are all about wealth maximization. So due to wealth maximization, the short term money lenders get their payments in time. The long term lenders to get a fixed rate of interest on their investment or dividend on their investment in the form of equity, or interest in the form of debenture given to the debenture holders, or long term loan if taken, so paying interest to it. So it's like a regularization in the payments. So the employee share in the wealth gets increased, and the value, the various resources are put to economical and efficient use if there is wealth maximization. So these are all reasons why wealth maximization should be an objective, right? Now, what is the contrast between profit and wealth maximization? As to understand, profit maximization is basically a single period or a short term goal. It is usually interpreted to mean the maximization of profits within given period of time, right? So a firm may maximize its short term profits at the expense of its long term profitability and still realize this goal. But in contrast, shareholders' wealth maximization is a long-term goal. It is a long-term goal. So shareholders are interested in future as well as present profits. So wealth maximization is generally preferred because it considers wealth for the long term, risk or uncertainty, and the timing of returns, and of course the shareholders' returns. That is the basic contrast between the profit maximization and wealth maximization. Now, this is the general model of financial management. Let's understand this. Now, the business house gets its the money, the capital from the market when it issues its debt or equity. So it the flows like this: the investors invest in the debt and equity, and then the money is received by the business houses. Now the business houses use this money for running out their businesses, like the recurring expenses, that is daily expenses, to for current assets and working capital requirements, and to invest in fixed assets and capital. This is how the business houses uses this capital. And after using this money efficiently, the excess returns over investment in assets and expenses are given to the investors. See, the arrow goes towards the investors in the form of dividends or interest, and to the business house, the brown arrow, in the form of profits. So it's a cycle, right? So this is how the business houses get their money from the market and utilizes it and efficiently, and then the excess amount is given to the investors back in the form of a dividend or interest. So this is how a general model of financial management. Now, there are three approaches towards financial management, that is investment, financing, and dividend. Let's understand them one by one. The first approach is investment decisions. Now, any modern financial management deals with taking these three types of decisions, that is investment decisions, financing decisions, and dividend decisions. This is the main approach. Now let's understand what is this is about. Now, when we talk about investment decisions, so investment decisions are those which determine how scarce resources in terms of funds available are committed to projects. Like, for example, the project may be as small as purchase of equipment or as big as acquisition of some particular entity, an organization, or another company. So investment in fixed assets requires supporting investment in working capital in the form of inventory, receivables, cash, etc. So investment which enhance internal growth in terms is termed as internal investment, and acquisition of entities represent external investment. So these are all about investment decisions. So it should aim at investment in assets only when they are expected to earn a return greater than the minimum acceptable return, which is called hurdle rate. So the minimum return should reflect whether the money raised from debt or equity meets the returns or investment made elsewhere or similar investments. The opportunity cost comes in. So the hurdle rate has to be set at higher for riskier projects and has to reflect the financing mix used, that is the proportion of debt and equity from where the money is acquired. So the finance function involves not only investment decisions but also in disinvestment decisions. For example, withdrawing from unsuccessful projects, restructuring with a strategic motive. So it relates to the careful selection of viable and profitable investment proposals. We'll be studying capital budgeting in our future in the fifth unit, wherein we will be deciding upon whether to select a particular investment or not. We'll be given choices like A, B, C, three types of investment, and you have to decide whether which investment is profitable for future. So we'll be calculating its net present value, its internal rate of return, its profitability index, and we'll be deciding. So this company decides on basis of this capital budgeting decisions whether to invest or not, whether to allocate the funds or not on that particular investment proposal, right? Because with a view to obtain what net present value of the future earnings of the company and to maximize its value. So it is the function of finance manager to carefully analyze the different alternatives of investment, determination of the investment levels in different assets like fixed assets and current assets. So the investment decisions of finance manager covers the following areas like assessment of total volume of funds a firm can commit, appraisal and selection of capital investment proposals, and measurement of risk and uncertainty in the investment proposals. Right? Prioritizing of investment decisions, fund allocation, determination of fixed assets to be acquired, right? And of course, determination of investments, level of investments in current assets like inventory, receivables, cash, etc. So, asset replacement decisions. So, all these things are very important when it comes to investment decisions, right? The next is finance decisions. Now, the financing objectives asserts that the mix of debt and equity chosen to finance the investment. Finance kahan se aayega? From where will the finance come? How much debt? How much equity? So, should maximize the value of investment made. For example, as I told you, the debt equity mix should minimize the hurdle rate, allow the firm to take more new investments and increase the value of existing investments. So the financing decisions relate to acquiring the optimum finance to meet financial objectives and seeing that working capital is effectively managed. A financing decision call for good knowledge of cost of raising finance, procedures in hedging risk, different financial instruments and obligations attached to them. So important principle while to consider financing is that long-term assets should be financed with long-term debt and short-term assets should be financed with short-term debt, right? So the firms that violate this basic rule do so at their own risk. So it is one of the important functions of finance manager is procurement of funds for the firm's investment proposals and its working capital requirements, right? Long term requirements and short term requirements I'm talking about. So in fundraising decisions, the finance manager keep in view the cost of funds from various sources. We're going to study about this in our cost of capital unit, wherein we'll be calculating different costs of cost on debt, cost on equity, that is cost of your investment. So a determination of debt equity mix is very important. The advantage and disadvantage of debt component in the capital mix, impact of taxation, depreciation, earning per share to the equity shareholder. It's very important because when your debt is more, that means you have to pay interest, fixed amount of interest to the debenture holders irrespective of profit or loss, so they are more riskier. But in case of equity shareholders, you may pay the dividend or you may not pay the dividend depending upon the profit. If there is no profit, you don't pay the dividend. If there is profit, good profit, you pay high dividend. Less profit, less dividend. So equity are less riskier, and debt, debentures, loans are more riskier. So it all depends upon what is your mix of debt and equity um, in your capital mix, right? So this is all very important factors while taking a finance decisions. Determination of degree or a level of gearing. Now these are what are this financial manager keep in mind when taking financial decisions. So determination of financing patterns of long term fund requirement, determination of financing pattern of medium and short term funds requirement, right? Raising of funds through issue of various financial instruments like equity, preference shares, debentures, bonds. what was the mix of it, how much to take a risk, all these things. And then arrangement of funds from banks and financial institutions for long term and short term requirements, right? Arrangement of finance for working capital requirement for day to day activity, short term capital. When you talk about working capital requirement, it is short term capital, right? Consideration of interest burden on the firm, right? If you have more of loan on more of debentures, more of interest burden, fixed interest burden, whether profit or loss, you have to pay interest. The burden is very high, so you have to decide, you have to leverage, right? That how much risk your company can take depend about the future profits the company would be earning, the market conditions the company would be going through. So there are a lot of things to be considered by the finance managers before deciding upon the mix of their capital structure, right? So as I told you, there are two types, like capital structure can be broadly divided into two types, like equity and debt. When we talk about equity, now the raising funds through equity through issue of shares attract flotation cost. So the shareholders expects the return in the form of dividends and capital appreciation of their investment reflected in the increase in stock market price, right? So the dividend payments are made only if the distributable profits are available with the company. As I told you, if it is not available, dividend is not paid. So after payment of all the interest charges, after payment of all the taxes, what is remaining is for equity shareholders. So any further issue of shares by the existing company may dilute the controlling interest. So the equity is considered as low risk but more expensive way of funding the company's projects. So the equity funds are not returnable except in the case of liquidation, however. So the buyback of shares is allowed under the provisions of Companies Act 1956, however. So the equity shareholders will participate in the policy decisions of the company. They select the board of directors and the representatives who take decisions. So in the company form of business, only legal personality exists. Hence, all decisions are carried out through their agents who work for remuneration, that is directors, and therefore agency problems arise with the managers because the decisions are taken by few board of directors selected by all equity shareholders. Right? They are spread all over the world. The next financing decision in the capital structure is debt. So, what are debt? The debt funds are raised in the form of either debentures, bonds, or long term loans. So, the expectation of the providers of debt is obtained return in the form of interest payments, which should commensurate with the risk attached to their investment. Right? The debt is repaid as per the agreement. Now, the interest should be paid irrespective of the profitability of the company. So the portion of debt component in capital structure will facilitate the trading on equity. That is, the interest on debt is payable at the fixed rate, and if the firm's return on capital employed is more than the interest payable, the excess return over fixed interest will be added to the profit available to the equity providers. So when everything is paid, interest to debenture holders, interest on bonds, interest on loans, taxes, and the remaining is for equity, of course. Distributable profit is called. So, but the high proportion of gearing, that is high proportion of debt, excess reliance on debt funds will increase what? The financial risk. Why financial risk? Because it has fixed interest. You have to pay it because the cost of debt is always lower than the cost of equity, of course, but it is fixed. Since any interest payable will reduce the tax liability of the firm because interest is tax deductible. You deduct the interest on debentures, loans, and then you calculate tax. So the non-repayment of interest and principal amounts in time is sometimes called for liquidation of the company, because if you're not able to pay interest to all these people, you may go into a liquidation. So it's riskier, right, than the equity. Okay, now third and the last decision is dividend decision. Very important. Dividend decision is concerned with equity shareholders, right? So dividend decisions concern the determination of quantum of profits to be distributed to the owners, that is equity shareholders, and the frequency of such payments, right? So it depends upon your reputation of your company, the goodwill of your company, that how frequently you pay dividend. If you are paying dividend frequently, that means you are earning good profits, right? So the dividend decisions will affect in two ways, right? The amount to be paid out and its influence on your share price, and the amount of profit to be retained for internal investments. which maximize the value of firm and ultimately improves the share value of the firm. The full profit is not distributed among equity shareholders. Some amount of it is returned as reserve. You have studied that. So general reserve. So how much you distribute, how much you keep aside as a reserve. So the level and regular growth of dividends represent a significant factor in determining a profit-making company's market value and the value of its shares in the share market. The higher the dividend you are paying, the frequently dividend you're paying, your market value of the share is high, and you are assumed as a good player in the market. So the dividend decisions of a finance manager is mainly considered with the decisions relating to the distribution of earnings of the firm among its equity shareholders, and of course the amount to be retained by the firm. So this both this comes into dividend decisions. So the finance manager will involved in taking but few decisions in dividend decisions, like determination of dividend and retention policies of the firm. How much to be paid, how much to put in the reserve retention, and consideration of impact of level of dividend and retention of earnings on the market value of the share and the future earnings of the company. They have to also think about repercussions in the future. See, they can't put more into reserves and give lesser to the dividend. They have to decide it wisely, taking into consideration the future earnings. And of course, the consideration of possible requirements of funds by the firm for expansion and diversification proposals for financing existing business requirements. They may also require funds in the future, and they can use it from the reserves, the retention that they are doing. So, reconsideration of distribution retention policies in boom and recession periods, they have to reconsider the policies in different periods, whether it is boom period, whether recession period. They have to change their policies depending upon the market condition. It's very important. So considering also the impact of legal and cash flows constraints on dividend decisions. So all these things are very important while taking dividend decisions. Because now let's understand how it is interrelated. Now the investment, the finance, and the dividend decisions are interrelated to each other. We have studied three. So and therefore the finance manager, while taking any decision, should consider the impact of all three angles simultaneously. He can't only consider investment decisions and ignore finance and dividend decisions. No. So while taking any one decision out of three, he has to consider all the angles of all these three decisions. So the function of financial management is a review and control decision to commit and recommit funds to new and ongoing uses. So thus, in addition to raising funds, financial management is directly concerned with production, marketing, and other functions as well. It is related to other factors in the organization, to the production department, to the marketing department. Different. It is interrelated. So the decisions are also interrelated, like decision on acquisition of particular and distribution of particular assets. They are also related to financing decisions. So this statement will reflect the modern view of financial management. From the point of view of modern corporate firm, financial management is related not only to funding and not only to fundraising, but encompasses the wider perspective of managing the finances of the company efficiently. Hence, financial management is nothing but major decision making an asset mix, capital mix, and profit allocation. So this is all revolves together, right? So financial managers are primarily concerned with the firm's cash flows because they determine the feasibility of certain investment, that how much is investment going to give returns in the future, the financing decisions. So the financial manager refers to accounting data when making future resource allocation decisions concerning long term investments, that is managing current investment in working capital, and when making a number of other financial decisions, like determining the most appropriate capital structure, how much of equity and debt mix, whatever, etc. So these are very important, right? Now let's understand that how finance and its relation with other disciplines, like the very first one is accounting, that how finance is related to accounting. Now financial managers play the game of managing a firm's financial and real assets and securing the funding needs to support these assets, of course. So accountants are the game scorekeepers. For example, finance managers often turn to accounting data to assist them in making decisions. So generally, a company's accountants are responsible for developing financial reports and measures that assist its manager in assessing the past performance and the future direction of the firm and in meeting certain legal obligations such as paying of taxes. So accountant's role is very important when it comes to finance. The next is how related to economics. Now there are two areas of economics we have studied in last semester: micro and macro. Now microeconomics deals with the economic decisions of individual households, firms, it individual, right? Whereas macroeconomics looks at the economy as a whole. So the typical firm is heavily influenced by the overall performance of the economy and is dependent upon the money and capital markets for investment funds. So, thus, financial manager should recognize and understand how monetary policies affect the cost of funds and the availability of credit. So financial managers should also be well versed with the fiscal policy and how it affects the economy. What the economy can be expected to do in future is a crucial factor in generating sales forecasts as well as other types of forecast. And thus the financial manager uses microeconomics when developing decision models that are likely to lead to the most efficient and successful operations within the firm. And specifically, managers use microeconomic concept for setting marginal cost equal to marginal revenue when making long-term investment decisions, that is capital budgeting, and when managing cash, inventories, account receivable, that is working capital management, etc. So this is how it is connected with economics. The next is how it is connected to marketing, production, quantity method, human resource, all these things. So now we depict the relationship between financial management and its primary supportive disciplines. So marketing, production, quantity methods, and human resource management are indirectly related to the key day-to-day decisions made by financial managers. Right? For example, financial managers should consider the impact of new product development and promotion plans made in the marketing area, because these plans will require capital outlays and have an impact on the firm's projected cash flows. Right? So, similarly, changes in the production process may necessitate capital expenditures, which the firm's financial managers must evaluate and then finance. The tools of analysis developed in the quantitative methods area are frequently helpful in analyzing complex financial problems. And of course, the compensation policies in HR may impact the extent of agency problems in the firm. So this is how the finance decisions are related to all these disciplines. So finance is interrelated and has relation with all other disciplines in and around the organization, right? And the last topic of this particular video is functions of finance manager. Okay, let's understand them one by one. Now, the very first function is estimating the amount of capital required. Of course, in the upper slides, we have already considered this, that this is the foremost function of financial manager, because firms requires capital for what? To purchase fixed assets, for meeting its working capital requirements, short-term requirements, for modernization, expansion of business. So the financial manager estimates of funds required both short-term and long-term, right? Next is determining optimal capital structure. Of course, once the requirement of capital fund has been determined, a decision regarding the kind of proportion of various sources of funds has to be taken. For example, financial managers determine the proper mix of debt and equity and short-term and long-term debt ratio. Now, this is done to achieve minimum cost of capital and maximize, of course, shareholders' wealth. Choices of sources of funds, that is, before the actual procurement of funds, the finance manager decide the sources from which the funds are to be raised. The management can raise finance from various sources like equity shareholders, preference shareholders, debenture holders, bank loans, or from other financial institutions, public deposits, etc. So they have to decide a choice of the source of funds. Now, the next is procurement of funds. Now, the financial manager takes steps to procure the funds required for the business. So, it might require negotiation with creditors, and financial institutions, issue of prospectus, etc. So the procurement of fund is dependent not only upon cost of raising funds but also on other factors like general market conditions, choice of investors, government policy, etc. There are a lot of things to be considered. Now, after the funds is procured, utilization of funds. The funds procured by the financial managers are to be prudently invested in the various assets so as to maximize the returns on investment, of course. So, while taking investment decisions, management should be guided by three important principles, that is safety, profitability, and liquidity. Right? Disposable of profits and surplus earned. Now the financial manager has to decide how much to retain for plowing back and how much distribute as dividends to the shareholders. The dividend decisions comes in, right, out of the profits of the company. So the factors which influence decisions include trend of earnings of the company, the trend of the market price of its shares, and the requirement of funds for self-financing and future prospects, future expansion, etc. So they all have to consider all these things. Next is management of cash. The management of cash and other current assets is very important task of financial manager. It involves forecasting of cash inflows and outflows to ensure that there is no shortage or no surplus of cash with the firm. Insufficient funds must be available for purchase of raw material and on time, payment of wages, payment of salary, meeting related expenses. So this is proper cash management. Daily cash management is very important. And the last is financial control, of course. So evaluation of financial performance is also an important function of financial manager. So the overall measure of evaluation, that is return on investment, ROI it is called. So the other techniques of financial control and evaluation include budgetary control, cost control, internal audits, break-even analysis, and ratio analysis. So the financial manager must lay emphasis on financial planning as well and control as well. It's very important to find the loopholes if there is any. So these are all the functions of finance manager. These all questions are very important from theory point of view. Your first unit considers only theory, and one question will be there from this particular unit. It is theory question. So you should consider this unit for only writing theory answers, because from the rest of the units, that is second, third, fourth, and fifth, there are numericals based. So we'll be conducting numericals on those particular units. So we have finished our first unit today. Go through it, study it, right, prepare notes, and let's meet up in the next class. See you all.